Welcome to the deep dive. Today we're jumping straight into the Spokane industrial market. We've pulled out the key insights from the Q3 2025 market report. And look, here's something interesting we found right away. Even though overall availability is still up there at 6.6% higher than Spokane's used to, historically, leasing actually picked up steam this quarter. That might mean, we could finally be past that peak availability point.
That really is the main headline, yeah.
Yeah.
And this deep dive, it's based entirely on what's in that Q3 2025 report. We're boiling down all the numbers, the analysis, the big trends, really trying to give you a clear, data-driven picture of what mattered this quarter. And we'll do it fast, under 15 minutes.
Okay, and just quickly before we start, if you need more context on anything we cover, or maybe you want a detailed breakdown for a specific asset class, you should reach out to Eric Peterson. His number is 509-903-9077.
All right, let's kick off with the quarter in a minute, the big picture. If there's one thing you take away, it's probably this. Q3 saw the Spokane industrial market shifting gears, moving away from that, post-supply shock feeling towards something more like maybe cautious stabilization.
Okay, stabilization, how did that actually show up in the numbers?
Well, we saw it in four key areas. First, demand. Net absorption was positive. Not huge, mind you, about 10,220 square feet for the quarter. But positive is positive. It means more space got occupied than vacated, and that helped keep the overall vacancy rate steady at 5.8%.
Okay, positive absorption. What about supply?
That's the second point, supply. Wow, developers really slammed on the brakes. The pipeline for new construction, it shrunk dramatically, like almost nothing. We've only got two projects totaling 215,000 square feet actually under construction right now. And the key thing, almost all of that space is already claimed, pre-leased.
Right, pre-leased is crucial.
Okay, third, pricing. Rent growth has, well, it's basically stalled. Market asking rents are up just 0.2% compared to last year, essentially flat, sitting at $9.18 per square foot. So that tenant leverage people were expecting, yeah, it's definitely here.
Okay, flat rents. And finally,
capital markets. Activity is still pretty slow. Sales volume is down compared to the historical average. But the interesting part is who is buying. It's shifted. Private investors and owner users, they're making up about 80% of the deals now.
so putting it all together, the bottom line summary is Spokane's industrial market seems to have weathered that big wave of supply. We're likely at peak vacancy now. And what happens next looks like it'll be driven mostly by the fact that hardly anything new is getting built. Okay, this is where it gets interesting. Let's dig into that vacancy signal.
Yeah, let's unpack that.
So context is key here, right? Spokane industrial used to be incredibly tight, like 3% availability sometimes. Then, boom, over the last 3 years, about 2.6 million square feet of new stuff hit the market, which is a lot for Spokane. And that pushed availability way up, peaking at 6.9% in Q3 of last year, 2024.
Exactly. And Q3 2025, this report, it's the first glimmer of relief. Availability nudged down slightly to 6.6%. Now look, 6.6% is still double that old tight rate, so it's high for us.
Yeah.
But it's moving in the right direction. And what's really interesting, I think, is how Spokane stacks up nationally. The report mentions the national availability rate is like 300 basis points higher.
Whoa, hang on. 300 basis points.
Yeah.
Let's translate that. That means the national average is a full 3 percentage points higher than Spokane's 6.6%. So, yeah, Spokane's actually looking relatively healthy compared to the rest of the U.S.
Precisely. Much healthier. And even within Spokane, it's not uniform. That supply hangover, it's really concentrated. Logistics properties, the big warehouses, they have the highest availability, almost 9%, 8.9% to be exact. They took the brunt of the new supply.
But what about the smaller spaces? Are they still hard to find?
That's exactly it. The specialized industrial sector, think smaller spaces, maybe for local businesses, more mission-critical stuff, it's still super tight. Only 1.3% availability. So, the takeaway. If you're a local, small or medium business needing industrial space, it's still very competitive. But if you need large-scale logistics space, that's where the inventory is, and that's what needs to be absorbed over the next year or so.
And the report actually says Spokane may be at peak vacancy. So looking ahead to Q4, the thing to watch is leasing, right? We need to see more deals like that big one in the valley. What was it, 112,000?
Yeah, exactly. Continued leasing velocity like that is key. That absorption speed will tell us if this stabilization trend is really sticking.
Okay, so availability might be peaking. Let's pivot to pricing, because you said rents are flatlining. 0.2% year-over-year growth. I mean, that's nothing compared to the peak we saw just back in Q2 2022. What was it then?
Over 7%, 7.2%, yeah.
A huge drop. Now, the report blames the supply glut, but Spokane's economy seems pretty solid. You mentioned 3.1% GDP growth. Shouldn't that have soaked up the supply faster? Is it just supply, or is local industrial demand maybe a bit softer too?
That's a really good question. The data, I mean, it heavily points to the supply surge as the main culprit. When you flood a market like that, 2.6 million square feet in 3 years, the power just shifts. Tenants get choices, they can push back, but there might be a secondary factor, and it ties into what we should watch going forward. It's about the type of economic growth we're seeing.
What do you mean?
Well, look at the longer trend. The report notes over the last 5 years, Spokane rents went up 22% nationally. 36%. We lagged behind quite a bit. So if the local job growth isn't heavily concentrated in sectors that use a lot of industrial space like trade and transportation, then dropping all that new inventory hits even harder. And that rent gap, it'll probably stick around until the inventory gets absorbed, and maybe we see more growth in those core industrial job sectors.
Kind of a chicken-egg situation then. Need the jobs to fill the space, but maybe the space needs the right kind of jobs.
Something like that, yeah. And you see it in some markets too.
Yep.
West Plains, with all the new and attractive developments, is still seeing some rent growth like 2.2% annualized this quarter. But outside Metro South, rents actually dipped slightly, down 1.6%. So the market's definitely not moving as one single block.
Okay, so flat rents are let's say, the consequence. But the cause is being addressed by this construction slowdown.
Exactly. That's the corrective measure. The contraction is the supply safety valve, if you will. Developers really hit the brakes.
Give us the hard numbers again. How little is being built?
It's tiny. Just 2 projects totaling 215,000 square feet are under construction right now. That's only 0.4% of the total market inventory. It's practically nothing in terms of future supply risk.
And you mentioned the pre-leasing on that was really high.
Astonishingly high. 95.3% of that 215,000 square feet is already pre-leased.
Wow. Okay, so what does that 95% figure really tell us about market stability going forward?
2 big things, I think. First, whatever is getting built now is basically de-risked. It's being built because there's a tenant already lined up. It's demand-driven. And second, it means any remaining supply pressure is coming only from buildings that are already standing empty. There isn't another big wave of construction about to hit us. In fact, the biggest project, that 205,000 square foot King Beverage facility out in West Plains, that's not even scheduled for delivery until late 2026.
Okay, so nearly 2 years of breathing room, minimal new competition coming online. That timeline seems really important for letting the market naturally absorb that existing 6.6% availability.
Absolutely critical. The report basically says only one other major project is slated for next year. It gives the market that crucial time to work through the hangover from the last few years of heavy building. This is probably the strongest piece of evidence supporting that peak vacancy idea.
All right, let's shift gears from supply to the money side. Transactions, you said overall sales volume is down?
Yeah, significantly. The 12-month total is about $85.7 million. Compare that to the 5-year average of $128 million. It's a big drop. Volume is definitely down.
But Q3 itself still had some noteworthy deals close.
We did, yeah. Despite the slowdown, there were 3 key sales between July and September. The biggest was 17524 E Euclid Ave. That's a pretty large building, over 106,000 square feet. It sold for $11 million, which works out to about $103 per square foot. Definitely an institutional-sized deal, even though we don't know the specific buyer-seller strategy. Shows big money is still looking, just maybe more carefully.
Okay, one big institutional-type deal. What else?
Then there was one MIG 668 East Brogue Ave, much smaller, about 12,600 square feet. Sold for roughly $2.66 million, or $211 a foot. What's interesting there is the cap rate. It closed at 6.3%, which is pretty low among the sales listed with a disclosed cap rate.
Okay, hold on. Remind us a low cap rate. What does that generally signal?
All right, so the capitalization rate, it's basically the property's annual income divided by its price. A lower cap rate usually means the buyer thinks the property is very safe, high quality, or has good growth potential. They're willing to pay more for each dollar of income it generates. So that 6.3% suggests strong confidence in that specific property.
Got it. Low cap rate, high confidence. And the third big sale?
The third one was 1624 E Lyons Ave, even smaller, 6,000 square feet. Went for about $1.25 million, around $208 over a foot.
Okay, so a mix of sizes. And you mentioned the type of buyer has changed.
Dramatically. Historically, the big institutions might have made up 40% of the buying volume over last year. Totally flipped. Private investors are dominating around 80% of the deals and 80% of the dollar volume. The rest is mostly owner-users buying buildings for their own businesses.
So it seems like the big institutions, maybe they rely more on complex debt, stepped back when rates shot up,
That's likely a huge factor, yeah.
leaving the field more open for local private buyers, maybe using less leverage or all cash. Okay, so if sales volume is down, but private buyers are active, where does the report see pricing heading? Are we going to see a big correction?
That's the million-dollar question, isn't it? The report actually offers a pretty interesting forecast here. It suggests that because vacancy seems to be peaking and you still have these private buyers active, pricing is likely nearing its low point for this cycle. They're basically calling a floor or suggesting one is close.
A floor, not a crash. That sounds relatively optimistic considering the slowdown. Why?
I think it's because that underlying demand from the private sector and owner users hasn't just vanished. And crucially, the future supply risk is almost zero now because construction stopped. Look at the average cap rate. Across all the comparable sales in the past year, it was 6.8%. The thinking is, as rate volatility maybe eases a bit and these active private buyers start competing more, that could put downward pressure on cap rates again, which would confirm that prices have found their footing.
Okay, so the outlook isn't doom and gloom. Let's talk broader outlook then.
Generally, the report paints a picture of stability for the Spokane industrial market. Risks seem pretty balanced right now, and the local economy does provide some real tailwinds.
Yeah, let's highlight those. Spokane's economy did well, right? 3.1% GDP growth last year, better than the national average. And things like the Amazon expansion near the airport must help regional logistics.
Those are definite pluses, absolutely. But the report also flags three things you really need to keep an eye on moving forward. First is the affordability crunch. We touched on it with labor, but it's key. Rising housing costs are making it harder to attract and retain workers. The report points out apartment rents jumped 20% between 2020 and 2025. That actually outpaced cities like Portland and Seattle. That cost of living directly impacts the labor pool for industrial companies.
Okay, affordability impacting labor. What's second?
Second, absorption speed. Plain and simple. Now that new construction is minimal, how fast can the market actually lease up the existing vacant space? The forecast is pretty positive, predicting vacancy drops to 6.1% in 2026, then 5.9% in 2027. But we need to actually see that leasing happen to stay on track.
Makes sense. Monitor the leasing velocity. And
Third is that job diversification issue again. Where is job growth strongest? Right now, the report says it's mainly in education, health services, and leisure hospitality. For the industrial market to really thrive long-term, we need to see stronger growth in its core sectors, like trade and transportation, to really drive demand and pull those vacancy rates down faster.
So if Spokane can navigate that housing cost challenge and see the right kind of job growth, then the forecast of peak vacancy and stabilizing prices seems pretty reasonable.
I think so, yeah. If the regional economy stays healthy and manages the labor supply side, the path outlined in the report, peaking vacancy, stabilizing prices, looks quite achievable.
Okay, so the big takeaway from the Q3 report seems to be a clear signal of stabilization after that heavy supply wave. Construction's basically off. The focus now is all on leasing up what we have. It'll take some patience, but the overall outlook feels cautiously positive.
Yeah, it's a rebalancing act.
Yeah.
And that creates, maybe some interesting opportunities for investors and tenants who understand the nuances right now.
Absolutely. Well, that's our deep dive for today. For more detail, or if you want a custom market breakdown based on the full Q3 2025 report, remember you can reach out to Eric Peterson. Again, that number is 509-903-9077.
Thanks for tuning in. We hope this look at the Spokane industrial market was helpful for your planning and strategy.